Hello, this is Paul Leeson with Berkshire Hathaway Home Services. And a question that I've been asked about at the moment, or a lot of apprehension, I guess, is around the interest rates currently in the 2024 market. Current interest rates are hovering around about the 6.75%. And I think a lot of buyers are sat on the sidelines waiting for interest rates to come down after we've been used to the very, very low 3%, 4%, 5% for a while. So that got me thinking, and I started looking at some data to see whether it's best to wait a while and wait for the interest rates to come down, or to actually purchase now. Um, the word is that interest rates will come down probably this year, maybe only to 6%, and we're currently at 6.75. So I did a study that I'm going to share with you right now, and we can take a look and see what you think of it. And please give me some comments. So looking in Grand Rapids market, I'm looking at 2024. If you were purchasing now, purchase price of 300,000, which is around the median housing price for Grand Rapids. Increase, I've got a market increase here of 5%. That's based on even conservative. I have the Realtor.com top housing markets for 2024. And as we scroll down here, we see Grand Rapids, Kentwood in there in the Midwest for 7.2% appreciation. That's for 2024 existing home median sale price year over year. So they're looking at 7.2%. So yet again, Grand Rapids is on the radar for being a great place to purchase a home or to invest in a home because of its strong appreciation. So let's go back to the spreadsheet. We'll put 7.2 in here for the market increase. Saying a 20% down payment, we can change that. That's $60,000 for a loan value of $240,000. Current interest rate, 6.75%. That gives us a principal and interest PI payment of $1,556. And then taxes here, you see I've got a millage rate of 32 mils, and multiplying that by half of the purchase price. So here, 300,000, that's the way the taxable value is typically calculated. Basically 50% of the state equalized value, and that equalizes to the taxable value. That's a whole nother discussion. But $4,800 a year. So your monthly taxes around $400 a month. Insurance, I've put in there $1,200. And then your PITI, which is principal, interest, taxes, and insurance, is $2,056 a month. So then if we look at the other scenario and saying, well, let's wait a year, let's try and allow these rates to come down. I've got 5.5 in here, which is a little aggressive. Let's start with 6%. With a 7.2 market increase, that same property next year is going to be 321,600 with that 7.2% increase. Down payment of 20%. So now your down payment amount has gone up by $4,320. So that's another $4,320 out-of-pocket expenses that you'll be bringing to close. Loan value will also go up from the 240,000 to 257. So an additional $17,000, 280 on the loan. Interest, if I have the interest rate at 6%, so it's gone down 0.75, which is anticipated for 2024, then my PI, we're actually only saving $14 a month. However, if you look at the property taxes, then the property taxes will be based on a higher sales price, potentially. So 5146 versus the 4800. So that gives us an extra $346 per year, $29 a month. And then, so if you look at the monthly taxes, the insurance estimate, your PITI, principal, interest, taxes, and insurance is a grand sum of $2071.32. So actually $14.69 more expensive if you wait until next year for a lower rate at 6% versus 6.75% now. And the other thing is, in that first year, if you were to buy now, you would have principal pay down amount of $25.57. By the end of the year, you would have increased your total equity increase would have been 24,157. How have I calculated that? That's the 2557, which is your principal pay down. So in your principal and interest payment, that principal is being paid down a little bit every month. So that's an extra $2,500. And then you have this delta here between your 300,000 and 321,000. So your property has gone up 21,600 with that 7.2% increase. So your total equity increase over here is actually 24,157. So looking at this, you would see the benefit of purchasing now and allowing the market growth to to bring up your equity in your property. Now, if you're renting, this is a double whammy, because if you're paying like $1,200, $1,300, $1,400, $1,800 a month, that's extra money that you're paying, and then you're never going to get back. So definitely, if you're renting, I think it's a great time to jump on and purchase, because with the increasing house prices, you're going to be building equity as opposed to paying a landlord. Now, I'm a landlord and I love my tenants. So it depends on which way you're looking at it. So if we look at this and just go a little more easy on the market, let's be a bit more pessimistic and say 5% market increase. And then let's go a little more optimistic on the interest rate and say 5.75%. Property taxes are still going to go up. You're down 1% on the interest rate. Principal and interest payment actually improves by $86. And then with the taxes and insurance, you're saving $66 a month. Total savings in that first year of $792 if you were to wait and purchase next year. However, you got principal pay down. That money has been going into paying down the property of 2557. Plus you have the increase in the value of the property itself. So you get a total equity increase of 17,557. The other thing to bear in mind is that with a lower interest rate, do you think more people are going to be coming to the market? Those people who are sat on the sidelines right now, more of those people are going to be like, okay, let's get into the market now. The interest rate is down at 5.75. What does that create? That creates competition. Competition like we saw in the start of 23, 22, 21. Competition leads to multiple bid situations, waiving inspections, doing appraisal gap coverages, giving away possession giving away possession after close. As a buyer, you're allowing the seller to stay in the house. So you're losing leverage then on your negotiation if there's more people looking for that same home. So if we say we're going to offer 5% over asking, so for a $300,000 home today, next year that would be 330,000. Sorry, without the, let's take that back out. It would be 315,000 with a 5% increase. Now, if we have to offer 5% over the asking price of 315, we plug that in, comes up at 330,000. And then you see the numbers here with only a modest market increase of 5% and sizable drop in the interest rate of 1%, you still end up paying an extra $28 a month in 2025 versus 2024. So, and then you also lose out on that equity increase, $33,000 of equity increase that you would have gained on that property by buying it in 24 versus 25. So personally, I see benefits of buying now in 24 than waiting to 25, because the markets all seem to be tending or trending upwards, and we don't see that the markets are going down. Sure, the markets have slowed up, but the appreciation, the market increase of 5% is a modest and a realistic look at the market and where the markets are going to go. In the past years, we've seen 15, 20% increases depending on your location within the Greater Grand Rapids area. So that's my take and spin on the situation. If you have a specific situation you would like to discuss and plug these numbers or those numbers into this spreadsheet, let me know. I can send you this spreadsheet, and we can do a case-by-case scenario looking at Grand Rapids schools, Comstock Park, Caledonia, wherever you are located, or looking at buying. So once again, Paul Leeson, thanks for tuning in. My contact details is 616-717-1901. Hope that this was useful for you. Bye for now.